Hello everyone and welcome to your Glassnode Week on Chain report for week 5, 2022. Last week we focused on whether this market structure really described a bear, and we were looking at things from a supply dynamics, and that's essentially where the coins are, who owns them, and how they're moving through the system, and also a network profitability, which is that those folks who are underwater and holding coins that are at a loss are more likely to sell them, and vice versa. When coins move into a high degree of profit, that also creates an incentive to sell. What we're going to look at in this week's report is a bit more about two sides of the equation: the demand side and how we can really assess on-chain demand using these tools. And the other one is looking at the leverage futures and options markets, which are starting to show somewhat of an interesting characteristic of the overall market getting quite negative, starting to layer in what looks like somewhat of a short bias. So what we're looking at here is essentially as the market trades down to about 33K, the market's getting exceedingly negative with leverage. And then we combine that with an assessment of demand. So we're trying to look at what is the probability that the market's trying to put some kind of bottom in, whether it's temporary or a more long-term macro bottom. So we have been in this downtrend now for 82 days. So it is a fairly substantial downtrend. But what we're really looking at here is whether the on-chain demand is creeping in. And we know that during bear markets, there's a good saying that bear markets author the bull. And what this means is that there is a process of coins transferring from those who are going to sell in the bear market and those who are stepping in and actually accumulating those. And eventually that accumulation does come to an end. So what we're trying to assess here is that demand profile there? Are we seeing people actually stepping in, and what are the different wallet cohorts that are really representing that? Can we look at Confluence? Are we looking at things like our exchange outflows? Does that typically match the amount of supply that's moving into certain wallets? Is it really describing accumulation, or is it still telling us we have distribution underway? And we're going to look at those two other sides, which is the derivatives markets, futures and options, and the negativity that's creeping in there and what that may mean in the near term. That's a more short-term effect. And we're lastly going to close on what I call a fair value model that was originally developed by Willy, and it's looking at transaction volumes or the utility of the network to try and estimate what is a fair value for Bitcoin. So just bringing in one of these new models that can be quite interesting to really track the fundamental side of things. So let's get into the charts and get started for the week. And just a very, very quick reminder, please do give us a like and a subscribe. All of these things really help our channel grow. Again, make sure you're putting comments in there that we can understand what it is you're looking for. We're putting out more on-chain 101 videos and different forms of content. So do let us know what you're enjoying about the channel. We will keep bringing you content that, we're reading all these comments and trying to bring you the best value. So do let us know what your thoughts are. And we really enjoy reading those. So thanks for putting them in there. So here we are in Glassnode Studio. We're looking at our week on chain number 5 dashboard. You'll find a link to this dashboard in the description of the video. And what we can see here is that we have been in a fairly lengthy downtrend. For about 82 days now, Bitcoin has been trending lower. And sometimes it can feel a lot longer than that when you're actually looking at the market all the time. Now, what we've seen is a relief bounce. Now, this is pretty typical. We do see that markets rarely trend in one direction. Both to the downside, there's corrections back to the upside. And when we're trending higher, there's corrections to the downside. So some kind of a relief rally is expected. What we're now trying to do is assess the health and what's driving that actual bounce. Is it something sustainable, or is it something that's going to take a little bit longer to play out and may not necessarily be the bottom? So the first thing we're going to look at is the futures markets. And in particular, we're looking at perpetual swaps. These are futures that don't have an expiry date. And the way that they keep the futures price in line with the index or the spot price is using the funding rate. And we'll talk through these different mechanisms. So what we have here is our futures open interest in perpetual markets. So these are these swap markets where essentially there is no expiry. We can see that the open interest has been declining alongside price, and there's been a handful of these very vertical drops. And these are essentially deleveraging events when lots and lots of contracts are forced close, typically corresponding with liquidation events. Now we actually have our long liquidation dominance down here. When this chart is green, it means that the people who were being flushed out at that point in time were long traders, they were buyers. And when we see when it turns into this red color, it's showing that shorts, essentially it's the opposite side. Lots of people went very, very short the market. And then when it traded higher, it squeezed out those traders. So really what we're looking for here is how much of the market was going long. Very typical during a downtrend, people are trying to catch the falling knife. And we see these long traders getting flushed out and flushed out. And you can see that after an extended period of long liquidations, we actually moved, particularly after the May, June, July sell-off, we moved into a regime of short liquidation. So people who couldn't believe that this rally was heading higher and believed that we were going to roll over and head back down towards zero, people were shorting the market, and they were actually the ones getting squeezed out. Now, when shorts are getting squeezed out, it creates buy pressure. It's a forced buying. And the same to the downside. When you have too many people trying to catch the knife, it creates a downside sell pressure because they have to close out their position, which means if they bought, they have to sell out. Now, very commonplace is we see a spike in futures volume at the lows. So as we traded down to 33,000, lots of folks who went long, we can see we had a long liquidation here. Essentially, we were seeing a bunch of people who didn't believe it could go lower than 35 or 36K, and they were the ones getting liquidated. Now, the other thing to bear in mind is that after 82 days of downside, the bears can become quite confident. They've seen the market just go down and then go down and then go down. And also a lot of the folks who are getting liquidated on the way down can start to think, well, maybe I can win all of the money that I lost back with one trade and go short because look how obvious this downtrend is. So the longer that the market trends, the more confident that side of the market gets. And sometimes that can actually set up for movement in the other direction because you have too many people who are putting leverage bets to go short at the end of a very, very long downtrend, and you essentially build up this clustering of positions that can create that short squeeze. And this is essentially what we saw, particularly in July, when we had that rally from 29K. This was a short squeeze driven. So we saw all of these people who go, right, that's it. Bitcoin's going to zero. It's time for me to lever up. And they were the ones that actually got squeezed after such a long period where they were correct. They were wrong at the very wrong time. Now, if we look at our funding rate, this is a way we can assess that directionality. We can see this negativity creeping in. Let's zoom in and we'll look at our May, June, July period last year and compare it to our current zone. So we can see that through that entire correction, the market was net short. Overall, we were seeing people who are paying an interest rate for the privilege of going short. Essentially, they were pushing the price lower than the spot market. The funding rate was saying that shorts had to pay longs for the privilege of going leveraged short. Now, we saw the same here in September, where essentially the short traders got squeezed out yet again. And you can see that typically when it goes for an extended period of time in the wrong direction, too many people going short, as price gets lower, they get too confident and the market squeezes them out of their position. The exact same at the tops. People go very long, they're paying a high interest rate for the privilege of being long with leverage, and the market squeezes them out. Now, note that we have this declining open interest, but we have an elevated level of short interest. We're seeing more and more shorts in the market as the price goes lower. And again, this is speaking to overall traders on the short side are getting more and more confident. It's showing that there's negativity and people believe that this is going to go lower. And that potentially signals that there's lots and lots of traders who are clustering their stop losses on the short side around the current price. It increases the probability of a short squeeze. Now, if we look at the options market, we can also see a very similar overall open interest profile. We can see these closing out after on the December 31st when all those contracts closed out. We haven't seen a huge explosion in overall open interest for the options market, but what we have seen in our put call ratio. So what this is looking at, a downtrend in this metric shows that more people are betting on the long side. They're speculating that Bitcoin's going to go to 100,000, 200,000. They're buying call options. Now, the other side, when this market starts to trend higher, which we've seen over the last couple of weeks, or pretty much through all of January, this means that more and more people are buying put options. Now, a put option, the way to think about it is like downside insurance. They're buying insurance in case the price goes lower. It's almost like buying protection on your overall stack of coins. And what is interesting is we've seen this reversal after a long period of call option dominance. More and more people buying calls, speculating on higher prices. We have since seen a reversal and more people are buying downside insurance, interestingly, after a very long time of trending down. Now, the best time to have bought a put option would have actually been up the top here because they would have been quite cheap. Nobody's buying insurance before the house is burning. After an 82-day downtrend, we're now seeing that people are going, oh, maybe I should buy some downside protection, should buy some insurance in case the market goes lower. And what we often see is these kind of net reversals, this negativity that's building in both in the funding rate and in the put call ratio is showing that the market's getting quite negative as the market trades lower, when realistically the right time to have been negative was actually up at this higher level. So it does add the potential that maybe there's lots and lots of traders who are now potentially betting that it's going to go lower, and maybe that sets up for a short squeeze. Now, the other side to this, and just to be very, very careful, is that the macro market is a huge part of the current market dynamics. And the reality is that it's unlikely that we are out of a bear market. So what we really have to pay attention to here is this short squeeze, if we does start to manifest, it's more than likely going to be a shorter term phenomena. So this is a very near term type observation, rather than putting an end to the bear and the market rips up to all-time highs. Of course, these things can happen, but we still have to take into account last week's report, which I would recommend you go back and have a look at because we explore these dynamics. Keep in mind that a lot of this is in the context of a bear market. So just bear that in mind. And we really need to see whether that can actually reverse and put in a macro bottom. So now that we've looked at the derivatives side, let's transition over and look at the on-chain side. And this is a little bit more exciting from my end, at least, because I love to see how the market is flowing around within the Bitcoin ledger itself. Now, what we're looking at here is the demand side of the equation. We looked last week a lot at supply dynamics, long-term holder, short-term holder. What we're looking at in this session is the demand side. And there's a lot of tools we can use. And what we're looking for is a consistent story, confluence between many, many metrics. Now, the simplest metric is actually the number of addresses with a non-zero balance. So think about this for a second. When you have a market blow off top, which is not too dissimilar to what we saw back here in May 2021, and also you can see this again in the December 2017 top. What happens is investors who have been withdrawing, they've got lots and lots of UTXOs, different coins in their wallet. Each one of those has a separate address. So a single investor during a bull when they're buying has lots of addresses. Now, when they panic and sell, they spend all of their coins, or a great number of them, and they remove all of those addresses, send them to one exchange address, and then the exchange also consolidates all the people's deposits and puts them into their hot wallet. So many, many investors with many, many addresses suddenly becomes one hot wallet. So we see an overall reduction in the number of addresses in the network. And we saw this during the sell-off in May. Lots and lots of people essentially flushed out their wallet, spent and sold all of their coins, and they got consolidated into fewer and fewer exchange wallets. You can actually see this in our illiquid supply. So again, illiquid supply speaks to those coins in those investor wallets, ones that haven't yet been spent. And we can see a similar thing. Lots of coins coming out of cold storage into hot wallets, a reduction in illiquid supply. And if we look at our balance on exchanges, an increase in balance on exchanges. So we see a confluence as a consistent story between many of these metrics. Now, after a period of chopping sideways and a whole lot of volatility through May all the way through to September, as the market rallied higher, note that we've started to see an increase again. We're seeing this climbing of non-zero addresses. So what we're essentially seeing here is there is some kind of demand profile going on. People are creating more wallets. It looks like investors buying. And we can see this all the way through 2020 into 2021. And it was really only when it got very bearish here in May that we saw that flush out of wallets. In terms of the supply held by different entities, different wallet sizes, I'm looking here at the 0.01 to 0.1 BTC and then up to 1 BTC, just to tell a story about almost the sat stackers, right? These are retail level investors, the hodlers who are still here after all the volatility of the last 18 months. And you can see that their balance is just in a consistent uptrend. And note that it's actually accelerating as this downturn carries on. This really speaks to this class of investor seeing value as prices fall, and they're not flushing out their wallets. They're kind of a consistent base load of buy demand, which is quite fascinating. We're seeing more and more of these hodler types, retail level hodlers, who are just consistently stacking sats and interestingly buying more as the price falls. Now, we can also see this in our illiquid supply. Note we had an uptick this week, and this was non-trivial. This is about 51,000 coins over the course of the week as price fell. Now, what I really want to highlight here is the difference between the current market structure and what we saw in May, June, July. So in May, illiquid supply declined quite substantially, and we had 164,000 BTC. That's a huge amount flow into exchanges. This showed a loss of conviction, a whole lot of coins coming back onto the market, and hodlers had to step in and absorb that supply. Our exchange net position change went positive. This means inflows. And we were talking about 100,000 coins per day sustained for about a month. So you can see that obviously these are coins that are flowing in. There's also coins flowing out. So this is on net. But what we're seeing here is a huge amount of coins flowing in. This looks like a loss of conviction and a whole lot of coins that need to be soaked up by demand. We can also see the illiquid supply change is basically the exact opposite. Coins moved out of a liquid supply into highly liquid and liquid supply. So the way to think about this, if you've got coins in cold storage that have almost no history of ever being spent, they are classified as illiquid. Conversely, an exchange hot wallet or a trader who's always moving their coins around, they're deemed to be liquid or highly liquid. And typically speaking, when a coin is illiquid, it's less likely to be part of that sell side. It's more likely to be hodled. It's not guaranteed, but it's more likely to. So when we see this metric going red and our exchange balances going up, we're essentially seeing that loss in conviction. Coins flowing into exchange, someone has to buy them. Now let's look at our current market structure. This is also a 50% drawdown. We saw a 50% sell-off in May. We've seen a 50% sell-off in this correction, but we haven't seen the inflow of coins. In fact, we've seen 42,500 coins flowing out since the November all-time high. It looks very different to this. We're not seeing the inflow of coins. Rather than seeing a reduction in illiquid supply, we're actually seeing a continuous and persistent increase. And in fact, as price falls, there's even more coins going into an illiquid state. Our illiquid supply change has not gone red. We're not seeing coins being spent out of cold storage. We're actually seeing more of them going in. And we can see in our exchange net position change, we don't have a huge influx of coins. We actually have a significant outflow, 58,000 coins per month. You can see here that this character of the market is very, very different. And my takeaway from a lot of this is after we had this flush out in May, that scared a lot of people with the first 50% drawdown that most people who entered the market in 2020 and 2021, they've never seen this before. Those folks who stuck around and also the hodlers who have kind of been through this cycle many times, they are the ones who are still in this market. We've talked about this over previous videos. Most of the folks who just came for the hype and the excitement have left after May. And what we're left with is that core hodler base, which really you can see this in the data. They're fairly unshaken and they continue to stack sats. So it's quite a remarkable thing to see across many of these data points. And what I want to stress here is the most important part about doing analysis like this is looking for confluence. We have the same story showing up across all of these metrics we've just looked at, and they're telling a very different story. It does not look like the same market structure as what we saw in May. Now, again, let's just stress that there's a macro environment with Fed tightening and all sorts of dynamics in the world that is going to add complication to this. But this is essentially what we're seeing in terms of the behavior of the hodler class. And again, macro bottoms can take a long time to get put in. Bear markets can take a long time. It can take months, it can take years. But the idea is we're looking for, is this demand there? Do we believe it's sufficient? And is it eventually going to put a bottom? And this is really what we're trying to look at. And what we're going to close out on is an interesting set, which is looking at the transfer volume. And I'm actually going to blow this metric up into the full size, but what we're looking at is the total transfer volume on an entity adjusted basis. This is a clean data set. We've essentially we've removed internal transfers and exchanges managing their internal wallets. This is really a true view of economic activity in terms of the dollars that are moving around the system. Now, what you can see is we have a rising floor value. Note that even after each sell-off, there's more transaction activity going on chain. There's more value being settled. And who is actually doing a lot of this settlement? Well, since October 2020, this is a breakdown in terms of how big the transactions are in terms of a dominance perspective. Now, the dark green are coins that are $10 million plus. The lighter green is then a $1 million plus. And then we have 100,000 to a million, 10,000 to 100,000. And you can see that following October 2020, the dominance of these darker green colors really started to pick up. And particularly during this correction, we're up here about 75% dominance of coins that are $1 million plus. This is fairly sizable money. Now, obviously, there can be individuals in there, high net worth individuals, but it also is going to have some representation of institutional capital. It shows that overall, the amount of transaction activity that's going on is largely dominated by these $1 million plus transaction sizes. It shows that changing cohort of investors who are currently inside the Bitcoin network. Now, I mentioned that rising floor value. Again, we're looking at the total transfer volume here. So this is the US dollars that are being settled by the Bitcoin network. We can see in 2017, we had an explosion of volume up over $10 billion a day and an equally impressive collapse right back down. Now, the concept here is that when more people are using Bitcoin to settle value, in theory, it should apply more value to the network. It should be worth more. People are finding utility out of it. And likewise, when few people are using it and there's not much value settled, then we should really be expecting a prolonged bear market because people aren't finding it useful. Now, we've seen this explosion in value, right? Lots and lots of coins being settled, value moving around the network at the top. We had the 50% sell-off in May and we had the expected collapse. It didn't, however, completely revert and go back down to these low levels. It actually held up a higher floor. We then had another kind of miniature bull through August all the way into November. We saw again another peak and then a collapse in value, but again, not to the same extent. There's a growing amount of settlement going on. There are more coins and more value being moved around, and therefore the network is demonstrating there may actually be more utility. It doesn't look quite like 2017. It's suggesting that more people are sticking around. There's more value moving through the network. It is showing a more bullish undertone, even though the market price looks quite bearish. And now to really close this session out, we're going to look at a model that was originally developed by Willy. Now this is called the NVT price model. And it uses that same concept that the more that a network is used, the more transaction activity and volume is going through. In theory, the more it should be valued. Now what we have here is a number of different traces. We've got price in gray, and then we have two NVT price models. So this is again taking the amount of transaction activity and trying to imply a price. Now in the green, we have what I call a fast signal. This is using a 28-day median. And in the pink, we have a longer term signal, more macro, it's a 90-day signal. And what I would kind of stress these to look at, they're more like a fair value. Look at the amount of utility that the Bitcoin is providing, how much value is being settled by the network, and then let's use history to imply what the price of that should be. We're essentially using the utility of the network to derive a pricing model. And what you can see here, let's actually zoom into our current section. You can see that we're currently trading in between the 90-day and the 28-day. And the fact that it's in between those kind of signals that maybe it's inside that fair value zone at the moment. It's starting to look a little bit more like a value play. It's closer to some kind of fair value than it is to a cycle top. You can see that during the top here that we set in October and November, we were trading much, much higher than the fair value. And you could argue that created a gravity to actually pull price further down. You can see in 2018, we had very little transaction activity. So price was trading much higher than the green and the pink lines. And again, really until we finally came back and converged on that fair value, the bear market was in play. 2019, also we traded above fair value, but was getting pulled down as transaction activity dwindled. 2021 and 2020, we saw overall transaction activity explode, and you can see that the fair value supported price all the way up. And really, we found that bounce level here in July, but unfortunately, the transaction volume, the utility of the network didn't follow price, which again created that downside gravity. Now, the last thing is we have this orange oscillator, and what this is doing is taking a ratio between price and the 90-day NVT price. You can think about it like an NVT Premium. How much is Bitcoin trading above or below what we deem to be fair value based on transaction activity? Now note that we're at quite a low level right now. We're trading below the 90-day on price. And the last time that we were trading at this level was down here in May following the sell-off. Again, here in March 2020, when we hit the absolute bottom. We had a low value here at the end of the bear market in 2018. And then again on that first capitulation event here in the bear market, right, that started it following the $20,000 top. So the thing to take away from this is right now it looks like Bitcoin is in what we would call an undervalued zone using this metric. However, this can occur in a bear market that just provides a relief rally. So this is what we talked about earlier. Maybe this is just a short-term relief rally inside a macro bear. It has also signaled the end of bears and also the end of this major capitulation event. So you can see that on a number of metrics, it classifies as undervalued, but we also have to look at all of the other dynamics just to really set our expectations. It can still revert back to the downside after a relief rally. So what we're looking at here is, does the transaction volume, we want to see these NVT prices start to really climb and showing there's more utility, more people are settling value, more people find Bitcoin useful. And therefore, it's highly likely that we start to push higher. We need to have that fundamental uplift before price can follow, or sometimes you get a divergence where essentially we get the fundamentals and price follows later on. Conversely, if we see a falling off of that transaction activity, that would say the other side. It would say that maybe the gravity is still down to the downside, and that's another thing that we just need to be careful of. So just to summarize this week's session, we are looking at what looks like a macro bear market. And I do recommend go back and look at last week's video for week 4, where we look at sizing up a Bitcoin bear. That really tries to put everything into context on a supply dynamics and network profitability basis. But nevertheless, what we have seen is that there is an undertone of demand. There is still buy side that is going on within the market. We also looked at Confluence across both illiquid supply and exchange flows, and even looking at net wallet growth. So it's showing that there is demand there. The real question that remains is it sufficient to put a macro bottom into the bear? And the last thing is that leverage remains elevated, and it does appear to have a short bias. And when we look at this across a number of metrics, we're somewhat undervalued on the amount of transaction activity, and there's a lot of people who are betting it's going to go lower on leverage. So it's possible that in the short term, we may actually have a squeeze back to the upside, but just be careful because these market conditions can change very quickly, and macro is such a big part of this. And unfortunately, it's very, very hard to predict. It's quite political, and there's lots of things that can happen in the world that are unknown. So just be very, very careful in understanding the bigger picture as you understand these markets. So thanks for tuning in. Be sure to give us a like, review, and a subscribe. Share out this content so you can, show other people that this channel exists. We really enjoy getting your feedback in the comments. So we look forward to hearing what you want to see more of, and I will see you next week. Cheers.